This is your November monthly market update from the Wealth and Wisdom podcast, where we bring you timely insights on the economy and the markets viewed through the lens of wise and faithful stewardship. Markets are continuing to surge. The S&P 500 and the Russell 2000 have now logged 6 consecutive positive months, with the NASDAQ notching 7 in a row. We'll unpack what's driving the rally, what may come next as we move toward year end, and how investors can stay disciplined and purpose-driven even as markets run a bit hot. And before we dive in, a quick reminder for our Arizona friends: our Sleep in Heavenly Peace Twin Sheet Drive is underway at the JMA Scottsdale office now through December 15th. This initiative helps provide bedding for children in need, a simple and meaningful way to bring warmth and dignity to families this Christmas season.
Yeah, welcome to the Wealth and Wisdom podcast, where intentional planning meets that eternal perspective. It's November 2025. We're glad you're here. I'm Brian Cochran, president of John Moore Associates, joined by my associate Cole Leonida. Together, we serve successful and generous families through our firm, John Moore Associates. And we want to kick off today, this, as Cole mentioned, is our monthly economic update, just talking about some general themes in the economy. We'll talk about markets and where they are relative to their long-term average. It's one of our favorite things to do, and talk about sectors that are working and not working. We've got a lot to unpack today. But big picture, what's been happening right now is that the economy is doing surprisingly well. We've had some ups and downs, but the good news is that despite tariff fears, inflation's not terrible right now. We're sitting around 3.7% in the U.S. The Eurozone is now below 3%. The UK at 3.8%. That's allowed the Federal Reserve and other central banks to cut rates and be more accommodating to their various economies. Our own Fed leader, Jerome Powell, has mentioned that data right now is a little foggy because of the lack of good data coming from the government during the shutdown. But the Fed's going to do its best to remain very data dependent and continue possibly cutting rates. We'll see what we see in terms of inflation and jobs. The job market is normalizing. Some people make it sound very negative right now, but really you just look at where we've been post-COVID, where it seemed like everybody could have as many jobs as they wanted to. We're kind of going back to a normal jobs market. And so it makes sense that rates might come down a little bit to be more accommodating. So overall, not a bad economic backdrop, which has supported a good market. And Cole, do you want to talk about, when we say good market, what are we talking about in terms of performance? Where are we relative to trend? And what sectors are really driving that?
Yeah, so I think this is a great spot to jump in. We've got a couple of really meaningful slides on what we're seeing in the market right now. There's a really good recap of what we've been seeing with the economy, Brian. But if I could draw our attention to volatility. This is something that we really keep in the forefront of our mind when we're talking through markets with clients. This is going back to 2014. This is not the first time that you all have seen this if you've been watching the podcast for the last couple of months. The orange line is volatility in terms of daily percentage price change, and the blue line is the S&P 500, or what we'll just refer to as the market. Generally, when we see volatility spike, we see markets fall. That is very typical. We see markets go down in elevators and oftentimes up in stair steps. And generally, every 12 to 18 months, we'll get a little bout of that volatility. That trend has changed the last couple of years. We had the COVID big outlier spike of volatility and the huge move down on the market. Then 2021 was very low volatility all year going into 2022. When volatility picked back up, markets were smooth in 21 and then choppy in 22. And then 23 and 24, volatility was low. Most of that 2-year stretch, markets pushed higher, making all-time highs many times. And then we got a little bit of an elevation in volatility that culminated with the tariff tantrum in April. Since then, stock market volatility has fallen back to historic lows. Bond market volatility has done the same thing. We're seeing very low, what we would call cycle lows in both stock and bond market volatility. So stocks and bonds, as you would assume, have been doing really well the last 6 months. As we said, the S&P 500, the Russell 2000, the NASDAQ, all making all-time highs, just doing incredible things over the last 6 months. And bonds, those are up the aggregate bond index, last I checked, was up over 7% on the year. It's been a long time since we've had such a strong year on bonds. So volatility has been a big story because aside from these big jolts periodically, volatility has been really low really since the beginning of 2023, and that has been a really good time to be an investor. So the next thing, Brian, you mentioned trend. Where are we relative to that long-term trend line?
Yeah, right now, when I say right now, this is as of our investment committee on Monday the 3rd, we are 12% above trend. So for context, we're looking at this long-term 10% average of stock prices plus dividends. So kind of the total return of the stock market. And we've been through highs and lows, certainly even just the last 5 to 10 years with the COVID crash back in 2020, with the big spike post-COVID. And now we're back to being above trend. Now, what does that mean, 12%? That suggests that we're not in some radical bubble. A lot of people have compared the AI boom to the tech bubble back in the late 90s. If that's the case, then we are in the very early innings because a 12% above trend market is not excessive. But it also warrants a little bit of caution. I'd say, Cole, from an investor perspective, I would look at this as a good time to rebalance or raise cash, not a time to sell all my stocks because a crash is imminent. Now, we can be proven wrong. A million things could change in the global economy. Geopolitical situations can change that could drive markets much lower. But right now, if the market dropped, it wouldn't be because it's in this massive overinflated bubble that should cause great concern. One thing I do worry about, though, Cole, is this is also not the time to ramp up your risk. You know, for those who have missed the rally post-tariff tantrum, so back in April we had the tariff fears really drove this market lower and has rebounded since, or maybe you sold out back in COVID in 2025 and you've missed, or excuse me, 2020, and you've missed the last 5 years. Either way, this is not the time to start cranking up your risk when we're 12% above trend.
Yeah, I would agree, though our forward-looking projections are on the positive side of things. There's lots of tailwinds for stocks right now in the next 3 to 6 months. Just because we are 12% above trend doesn't mean we have to come back down to that trend, or to your point, we don't need some big correction. In fact, we're right in the middle of earnings season right now, and earnings have been way better than expected. On the S&P, we're looking at 80+% of companies are beating on their earnings, and 85% are beating on the reported sales numbers. Those are really strong. That's way above the average beat rate, which is normally in the low 70s. We're now in the low to mid 80s on beating. And what we've seen is we were expecting about an 8.5% growth rate on earnings, and we're seeing double digits. We're seeing above 10% growth on earnings. It's just been a tremendous earnings season. And then that leads into this next slide. Earnings estimates going into the end of this year, the end of next year, and not pictured here is the end of 2027, which of course are estimates and are subject to change. The trajectory for earnings growth that is anticipated through the end of this year, next year, and the year after are incredibly strong. And this is, Brian, could you explain kind of how we get that 10% growth path on the market, and we're looking at a 7.5% growth path on the earnings?
Yeah, so that 10% growth is not just earnings growth driving stock prices, but also income from the various companies. So you take that 7.5% earnings growth plus a 2 to 2.5% dividend that comes through, there's your 10%. And I love that you came right to earnings, Cole, because this is a big part of why we feel this is not a bubble. If you had the type of stock price appreciation we've seen the last 6-7 months, but you didn't have earnings growth, you didn't have real earnings growth, or you didn't have projected earnings growth, you would definitely sniff out a bubble here. But you can justify where stocks are today. So when I caution against chasing this market, it's not so much that people shouldn't own stocks right now. That's not the case at all. Our portfolios are fully invested, and our clients participate in the stock market. It's more about trying to play catch up if you've been missing out, because even if this earnings projection comes true, you will still experience volatility. There'll still be misses. There'll still be certain companies that have high expectations that don't follow through. So we don't want to go into this market getting over exuberant or trying to play catch up if we've been sitting out because of our political bias or just because of general lack of the appetite for risk. But this is encouraging. I mean, this suggests that the stock market's not crazy. If these earnings come true, stocks are fairly valued, even if they are above trend. And those two things can be true. You can have a market that is ahead of trend but fairly valued. You can have a market that's below trend and overvalued if the earnings don't suggest a higher price. So we're in a good spot, though. It's great to see corporate health so strong, even though a lot of headlines, unfortunately, right now suggest that kind of on Main Street, the average American might be struggling.
I saw a stat this morning that since April's Liberation Day, that tariff tantrum from April, the cheapest stocks, so the ones that on a valuation perspective are the cheapest stocks are up about 28% since that bottom in April. The most expensive stocks are up 97%. So the expensive stocks have just gotten more expensive. This kind of lends itself to if there is earnings growth, if there is something pushing those stocks higher, just because they look expensive or just because we are above trend doesn't mean that there needs to be an imminent collapse or reversion to the mean. This could have some legs to go further. And with the idea that they are going to stop quantitative tightening, the fact that they have cut rates, and there's still about a 2/3 chance that they cut rates in December. That's what the bond market's saying. That's not our prediction. That's just what the market's saying. But they're ending QT. They're looking at cutting rates. Economic growth looks to be accelerating. Inflation looks to be moderating. And frankly, that can be a positive whether it goes up or down. There's lots of good news in the economy from the macroeconomic perspective that could be supportive to stocks going higher and getting more expensive.
Yeah, and I think what you're talking about is another good justification in my mind for diversification. Yes, you want to participate in those more expensive companies that have the momentum, that have a lot of this earnings growth we're talking about is coming from those same companies that look expensive. However, you don't want to put all your eggs in that basket, right? So, participate, but always still follow the key timeless principles of good diversification. And from a planning perspective, this is a great time to look at gifting some of those stocks that have been big winners. Is a good time to rebalance your portfolio to manage risk. We've done that a few times during this period of great growth. And just avoid the emotional decisions that would maybe set you back in a period like this. And I've been honestly really impressed, Cole, for any of our clients that are listening. Our clients have been exceptionally calm and disciplined despite the tariff tantrum and the drop in the markets, despite the conversations about this being a new tech bubble, despite political issues and economic ramifications of the government shutting down, and all the reasons you could have to want to sit this market out. Our clients have been patient. They're trusting our process. And I'm pretty proud of that. I think the challenge for a lot of investors right now is if they're going it alone, if you don't have a process, you don't really know how to navigate such a rapidly changing and in some cases very unusual environment that we're in for investors.
Yeah, and it really is, it comes down to process. There's an infinite number of ways that you can invest. There's even more ways that you can try to plan for your own financial future, but having a process in place and the discipline to see it through, that is what determines whether or not you are successful in this financial world. And I think that we talked about it a couple of weeks ago, talking about how fear can impact both sides of this. The fear of missing out, where you want to try to chase returns, or the fear of loss, where you're saying, hey, this market looks too expensive. I don't necessarily want to participate in this. What I would encourage you all with is to take a look at this chart. This is going back to 1957, so almost 7 decades of market history here. The blue line is the S&P 500. We've got our trend line drawn in there, and then you'll see all of these different crises that happened over the last 50 or 60 years. As one of our favorite economists say, crises come and crises go, but the market continues to move up into the right in the long term for that long-term investor. A lot of times, these big headlines, these geopolitical risks that can pop up are very short term when you just zoom out a little bit. And that perspective can be hard to have right in the moment when everybody's doing this or that, or you're seeing all the scary headlines about what could happen. Why don't we just look at market history and let that be one of our primary guides?
Absolutely. And that brings up one of our key roles, which is not just to have the process, but then to be an objective third party who's separate from the emotions of your finances, separate from the emotions that you experience when your portfolio declines and you feel fear. By the way, the fear you feel, the chemical reaction in your brain is not unlike the reaction you have if someone was pushing you towards the edge of a cliff. I mean, you feel legitimate fear for your safety when we go through market turmoil. So we don't blame anybody for this. I like to tell our clients that if you feel fear when things are going down in the markets or you feel overly exuberant when things are going up, that just means you have a functioning human brain, which I would hope is a great place for all of us to start. But so don't feel guilty about it, but we also have to acknowledge that that brings risk, that we can make decisions that would be harmful. So, so having an objective third party like us is a big part of this. We take a lot of pride in having good relationships with the families we serve so that we feel we have the trust built to have an honest conversation about client emotions and the more appropriate response to market volatility. But I think that's part of what gets left out when we talk about markets too much is the real battle is kind of between our ears sometimes. It's in our mind of how we respond to market ups and downs.
Yeah, and a big part of that is having a plan. Proverbs 21, verse 5 says, "The plans of the diligent lead surely to abundance." Now, that's not prosperity gospel language. It's emphasizing the fact that you need to have a plan and stick to it. And as Brian was saying, that's a big part of what we do. We, of course, make the strategy, but then we try to kind of hold your feet to the fire to see it through, even in times of uncertainty, especially in times of uncertainty. So we've talked about some practical takeaways coming out of this with what the market has given us so far year to date. Yes, we are probably on the optimistic side moving forward on what the market could do, though we've been wrong before. And in those events that were on that previous slide can come up out of nowhere. So potentially a good time to rebalance, of course, being cognizant of tax situation that you have in your own portfolio. This could be a time where you're harvesting gains or losses, depending on your own unique situation, taking that opportunity to rebalance. That could be done this year. Or if you've got too many gains you've realized, or you have some reason to push that rebalance into January, it could be a good time to be thoughtful about when you're rebalancing, when you're raising cash for upcoming distributions, or when you're adding cash. And Brian, what would you say to someone who's in that accumulation phase? The market looks expensive. We're 12%-ish above trend. If I've got cash on the sideline, what do I do now?
Yeah, I think steady, consistent investing, try to take the guesswork out of it. We call it staging, where if I have a large lump sum, maybe I sell an asset or I have an inheritance or something happens, I get a bonus at work and I want to invest it. Well, first off, you need to have that plan you discussed. Is investing part of the plan, or is debt reduction part of the plan, or is saving for an emergency reserve part of the plan? What's missing in your overall strategy? So start there. And if investing is the next step, then rather than holding back and trying to time the market, or rather than going all in one day, sometimes we'll spread those investments over 2, 3, or 4 months. We had one client recently that we were doing that, and then he said, well, September is usually a bad month, so let's not invest. Well, it turned out to be a good month, so you try not to outguess it. Just pick on every month on the 3rd, I'm going to make an investment into the market and spread this out. That way you're moving forward into the plan, and that takes some of the guesswork out of it. But again, try to remove that emotion, that temptation to time the markets and think that you know more than you do, because the future is always uncertain, right? So I think that's a really good strategy for people with new cash. And for those who are just investing their monthly income to their 401k, just keep it going. Don't stop right now just because the market's a little bit elevated.
It makes me think of Luke chapter 12, was it verse 25? Who can add an hour or a day to their life by worrying? There's so much out of our control. In fact, the vast majority of our lives is out of our control. What we can control is how we react and respond to our situation, who we surround ourselves with, what plans we put forth, and of course, where we put our faith and our hope, which we can all agree we're not hoping. That's not our investment strategy, but we are putting the outcome in the hands of the Lord, and we have to be okay with that. Whether it's a good year or a bad year in the markets, we have to be okay with that. So anything else you'd add before we close out, Brian?
No, I think you covered it. I just wish everybody a great Q4, a great holiday season coming up around the corner with Thanksgiving and then Christmas right behind that. We hope that it's a safe one and a great time for family and friends.
Yeah, thank you so much for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's conversation helpful, be sure to like and subscribe and share it with someone else who might benefit. If you can also find more resources and timely insights at johnmoore.com/insights. We look forward to being with you next month for another market update. And until then, stay faithful and stay focused in your stewardship, and we'll look forward to seeing you next week.